Other than that, India obviously is holding on, and no other major India style that kind of GDP growth is not happening in the near term.
Got it, sir. Sir, also a bookkeeping question, if you can share the revenue breakup for the quarter as well as for the full financial year, that would be really helpful.
Yeah, so the Q4, our revenue breakup was, rail was 34% in the quarter, and mobile others was 17% of the 898 crore of that quarter, and distribution was 19%, and process industry, which is stationery equipment, was 17%, and the exports were 14%. So that was for the Q4. And then for the full year, the rail stood at 23%. The mobile, which is the heavy truck off-highway, was 20% of the pie, and distribution was 18%, process was 19%, and exports was 20%. And if you see, that was the whole year 23-24, and if you compare this with 22-23, rail was 17%, and this year we completed, the pie was 23%, and mobile others remained flattish, 20-20, distribution same, 18-18, and process was 16 in 22-23, went up to 19, and the exports came down from 28% in the pie to 20%. So definitely we had almost 20% in the quarter on the export side. So that was it was heavily made up through our rail trade.
Thank you very much, sir. I'll get back in the queue.
Yeah.
Thank you. The next question is from the line of Abhishek DSP. Please go ahead.
Yeah, hi sir. Thank you for the opportunity, and thank you for those initial comments. Sir, just coming back to the current quarter, we have seen very strong growth as far as railways is concerned. Any thoughts? Is it led by more, wagon manufacturing kind of happening, and that's resulting in more bearing requirement? Is it Vande Bharat, or is it just one-off? Any some indication on the rail sustainability part as far as growth is concerned, sir?
Rail, obviously, the rail market is pretty much buoyant in India currently, both from the fact that more wagons are getting built, and then also Vande Bharat, and then whatever little bit of metro and also locomotives. So rail certainly is going to remain, as I always say, that this rail will always be better than the previous years for many, many years to come. India has to do a lot more in railway, and the intent of the Rail Mantralaya is very much there. So that is on. That is why we see Vande Bharat, we see speeds going up, we see electrification happening, and we see double tracks being laid wherever there were single tracks, which means that they want to put more trains on the tracks, and then dedicated freight corridors slowly, steadily picking up as they get more land. Definitely, they want to move freight out of the normal lines and keep passenger as lean as possible, so that more passenger traffic can be taken. So to your original question, it is a sustainable model, and that obviously in a quarter to quarter might be a little bit of aberration here and there, but year on year there will be always growth for next many years for rail in India. So that would be my answer for that.
Okay, that's very helpful. So would you still be maintaining a 50% market share, or would your market shares have moved up in railways?
We have this year it has moved up a little bit. So as you know that we've been in railways from our parent company also in this game for many years, and then we have created the optimum supply chains for railways. Our center of excellence of railways is in Jamshedpur in India, and then also on technology front, which we get from our parent, we are continuously upgrading those And whether it is sealing technology, whether it is greasing technology, whether it is the material science of it, extra, so that the residual life of these bearings go up and uptime of the rail in itself goes up. So that would remain to the core of it.
Okay. So, but just in terms of the railway part of it, you think you have enough capacity, or at some point will you also have to add capacity? Any thoughts on the same?
Good question. Certainly, I think the rail capacity, as it goes today, and we also exporting it in some markets at times are behaving like South America is behaving very well. And we are looking at these capacities very closely, and so that we don't want to be saddled with fixed cost, but at the same time we don't want to be saddled with non-capacity. So this is a very good point for evaluation, and we are evaluating and seeing how do we increase the throughput and also the base capacities. We have not taken any decision yet as we speak, but it is on our active consideration list.
Okay. So the other segment which has done well for you is the process part of it, which has been seeing healthy improvement. Sir, any thoughts, because that's a segment which caters to the steel, cement, and the power part of it, and we are seeing a lot of steel capacities coming, cement capacities increasing, a lot of solar panels are being put up. So any thought on the growth trajectory of this segment, which is process industry? Thanks.
Yeah. So both in terms of putting the new steel capacities in, which means that the more mills would come in, and then also continuous running of the steel mills so that the output is harnessed. So steel industry certainly will remain pretty healthy in India, and it should be. Our per capita consumption of steel is low. If you see countries like China and others, so our per capita consumption is pretty low, and we need to produce more steel, sustainable steel, green steel. But they all form of steel will need bearing. And Timken obviously for ages around the globe are well versed in the technology of the rolling mills and how do you produce those bearings. And as we speak, our Bharuch plant will also help us in this area, whether it's cement or it is power or it is steel. And we must be the only company in India which run more than 26, 27 roll shop inside the steel companies. You name the steel company, we are inside there 24/7, de-choking, mounting, remounting, and things like that. So this market will remain pretty nice as we need more steel for building the infra in India. And we from the Timken India side will remain close to the customer, and we'll make sure that we ride the wave as it comes. And it is obviously, we all know that a lot of steel companies are investing in enhancing capacities and also producing more and more. The shape and a little bit might change. People might start putting more electric arc furnaces, which means that they would like to reuse the scrap steel, etc. But they have to do rolling. They have to do rolling and things like that. So we see a nice growth in this market.
Great, sir. So one last question. In terms of the new capacity, we see fair amount of capex being done, almost about 260 crores kind of operating cash flow has kind of got invested, or capex has been done. Any thoughts on the timeline, sir? Are we on time to get it up and running by fourth quarter of FY25? When can one see the traction?
So just to give a flavor, main shop floor civil work has been completed, and our pre-engineering building is all up, and roofing is in progress. Our major high tension wire cabling, extra routing and all that substation switchgear work is in progress. I'm glad that our system, ERP system is already in place and is live currently for the new plant, and likely production start is same as per plan. So we should be able to, the machines are, either on the seas or on landing in Bombay from different parts of the world, as this is going to be a high-tech plant with a lot of robotics and IoT and things like that. So things are moving. And to the direct short reply to the question is that we are on time and should be tapping by the end of this year and commercial production thereafter.
Great, sir. I have few more questions. I'll come back in the queue. Thank you so much.
Thank you.
Thank you. The next question is from the line of Ankur Sharma from HDFC Life. Please go ahead.
Yeah. Hi, sir. Good afternoon. Thanks for your time as always. Just going back to the export piece, and if I heard you right, I think you said, in the quarter gone by, exports were at 14%, 14, right? Which possibly is one of the lowest we've seen in a very long time. So are we, obviously there would have been both a YOY and a sequential decline there. But are we like near or at the bottom, and therefore at least going into the next few quarters, we start seeing an improvement, or is that also a little difficult to call out?
So I would say that yes, this quarter was among the lowest. Definitely, you're absolutely right, bang on. This was among the lowest. While the next quarter might be a little bit better, but the idea of soft landing, which was earlier thought that by H2 US market would be up and running with full speed. That is not seen by us. Both we have a principal and we from here looking at that window. It is going to remain a little bit soft for sure. And short term, medium term, maybe the last quarter was among the lowest. I think it is bottomed out, and next quarter might be slightly better, and thereby, but kind of going up like a hockey stick is not happening this year. But definitely, next quarter might be better than the previous quarter, and thereby next slightly better. But overall, short term, medium term, export markets would remain soft, which means that if you look at the calendar year, January to December would be kind of soft, with the January to March among the softest.
Right. And I'm just wondering, because is it primarily driven by the weakness you expect in the heavy truck, the Class 8 market in the US? Because I thought you said the rail markets are doing okay, right? So it's more to do with a decline in the US market?
Yeah. So rail market in South America are doing well. Rail market in North America are okay-ish. And heavy truck market is not doing well.
Okay. So, okay. Fair. Okay.
And then, we are also exporting. Australia is also flattish. ASEAN is low. And so, overall, it is for the heavy truck, and even in India, the heavy truck is also flattish. So,
yeah.
So it is a little bit of a global phenomenon.
Yeah. And are we, or is the parent also exploring options of maybe sourcing more from us in India? Is that an offset or a lever that we may have as well?
So the global supply chain folks are always looking at options of sourcing, resourcing. But as you know that resourcing, changing source, it is like steering a very big ship, cannot be done overnight and things like that. So the evaluation of sourcing, the resourcing, all that will always be there. But the plants we have a plant in Mexico. We have obviously plants in different parts of US, and we have plant. The parent has a plant in China, etc. So sourcing from India will remain attractive. But overall, the markets are not really doing so well. So including the off-highway market in America, even that is not doing that well.
Fair. Okay. And just on the distribution piece, right, which is the aftermarket, and I'm assuming a more stable and also more profitable business for you. Fair to assume that keeps on growing in that 10-12% kind of a range, in line with maybe nominal GDP. Is that a fair assumption? And also, what is driving that growth there?
So, when you talk about aftermarket, there are two kinds of aftermarket. One is the MRO business for the industry. Say, for example, steel company needs to produce bearings, cement needs to produce cement. energy needs to produce energy. So obviously they have their life cycle for the building. So that market will keep on growing, and your GDP is 6, and any good company wants to outgrow the market. So if your GDP is going to 6, between 6 to 7, and you want to outgrow by say 50%, so you will grow double digits. That MRO market is bound to grow and grow. The other market is the auto aftermarket. So when new trucks are not built and auto aftermarket is obviously using more trucks or is carrying more payload and is obviously consuming more bearing. But auto aftermarket in India is always going after, especially the wheeling, going after cheap bearings, and differential premium doesn't get replaced so fast. So on the one side of industrial distribution, where we focus more, is going to remain pretty solid. And the auto aftermarket is going to be commoditized to a large extent, which is happening in the market.
Right. And just one last one on our utilization levels, both in Jamshedpur and in Bharuch. Fair to assume, while exports are a little weak, the strong growth in rail and the other industrial aftermarkets should kind of keep us fairly busy.
So Jamshedpur is running 6 days full 3 shifts. Bharuch is also running more or less full. We don't see that going down. But Jamshedpur is running flat out. I would say our Bharuch plant might be a little bit 5% less loaded. But overall, both plants are running currently as we speak, are running full.
And if you could also just give me the comparable, the sales breakup for Q4/23. I think you gave the number for 24. If you could just share the same for the last year. Thank you.
So Q4, if you want Q4 of 22 and 23, the rail was 23%, mobile others was 20, 19 was distribution, 18 was process, export was 19.
Got that. Great. Thank you so much. All the best.
Thank you.
Thank you. The next question is from the line of Rishi Vora from Kotak Securities. Please go ahead.
Yeah, thank you for giving me the opportunity. Sir, first on the margin side, if we look at it on a YOY basis, our margins have improved by 300 basis points. While operating leverage would have played its part, but at least in terms of mix, if you look at it, railway has done better and export has declined, which in terms of mix is inferior. So what explains the margin expansion, and do you think these margins are sustainable?
So margin performance largely is driven by volume and product mix. Utilization was better, so that helped the cause. When you can over leverage capacities, so that has an impact on the margins. And the second is that post COVID, the industry has been relentlessly leveraging cost or cutting waste or making sure that the waste is out of the system. And now, because of the push on ESG, especially sustainability, so everybody is trying to see and make sure that these supply chains are circular, they are shorter, smarter. So I would say that an answer to your question, strong margin performance in the quarter largely was driven by favorable volume and product mix, and the better cost leverage we have been trying to do in the area of supply chain. And on top of that, despite the fact that steel prices have come down, labor obviously keeps on going up. So we have been working very hard on price realization, and that has remained pretty much our continued effort on price realization despite softening of the metal prices. So that we are, generally the OEs would only look at steel. Now we are trying to discuss and bring their focus on the other aspects of the pricing. It is not only steel pricing. And when you are a natural supplier, how much productivity increase can be done over a period of time when you are already supplying for 40 years. So that is also a go-to strategy, especially when the application is where you can harness value. I hope that answers the question.
Thank you. The next question is from the line of Rajesh Kothari from Alpha Advisors Private Limited. Please go ahead.
Good evening, sir. Just a few questions from my side. The first question is on the railway side. Can you please share in terms of this growth? Because generally, the railway capex is yet to happen in a big way. So over next 2 to 3 years, do you expect this segment to continue to grow at 25 to 30%? And if yes, how much you think is primarily driven by, say, Vande Bharat and metros compared to, the freight related railway segment?
So I can't tell you whether it will grow 25 to 30%, but as I've been telling over the years that rail in India will always grow. The growth might not be like a huge hockey stick, but it is bound to grow year on year. It has to grow for the simple fact that we don't have enough track kilometers. When you lay more tracks, you need more trains, you need more stuff, and as you produce more steel, as you produce more cement, then you need those wagons to transport it. Then we have an aging wagon population as well. Despite the fact last 5-6 years we've been pushing these wagons, but still 300,000 population of these box and wagons need to be overhauled, especially replaced, especially because of the fact that dedicated freight corridor is slow, and we cannot afford to have a bag wagon or a hot axle on a track where the passenger is coming every 2-3 minutes. So long story short on this is that Indian Railways will grow YOY. It will keep on growing. Some years it will be better, some years it will be a little bit less better, but it will keep on growing. The other question is that India on the mass rapid transportation is bound to invest more. Every state, every city needs metro because of the fact that the roads within the city are limited. So your metro population will keep on growing. But then metros don't use mass amount of cars and bearings. But it is still a segment which will keep on growing. On Vande Bharat and related area is that now the good old Schellerian passenger car, which was the workhorse of Indian Railways, needs to be replaced all over India because of the fact that it has limitation on safety, etc. So the modern coaches of Vande Bharat and speed enhancement, etc. will keep on happening. And as you see Europe, as you see China, the speeds are much higher. We still have to catch on the average speed of say 175 km and then maybe beyond that. So this segment will also keep on growing. So whether it is 25% or 30 or 10, but every year will be better than the previous year. And the capex obviously has to happen. Now some years they might be able to buy like last mega tender was 90,000 wagons, and then there was a little bit less. Then again they are working on a master plan. So the master plan on infrastructure certainly has a major play for railways. And electrification, 1,000 locos a year and all that stuff. So this sector in India will grow for many years. Now whether it will grow 20 or it will grow 5, but it will keep on growing.
So while I clearly understand the macro tailwind, what we are witnessing, but in terms of the visibility, so typically how it works, you get a visibility for next 12 to 18 months because say companies like Texmaco or Jupiter, they might be, you might be supplying to them. So they give the advance orders to you, which has to be executed over 12, 18 months, or is it like every month you get the orders and then you have to supply to them?
Yeah, railways generally tend to be long-term orders. So then you win a bigger order and then you keep on supplying. So it is not even in a OE making truck, he will do an annual contract and then pick up based on his demand. And same goes for the wagon builders. They will do a large, if for example Mr. X building wagon gets a 20,000 wagon order, and which means that his capacity, if it is 3,000 wagons, a month, and he has to complete these 20,000 wagons. So obviously, he needs 3,000 into 8 bearings, 3,000 wagons, 8 bearing every month, which is 24,000. So he'll be using takes 5-6 months of order. And generally, rail, because of the fact that they need the wheelset, they need to mount the carriage and turn it out. So they want to push it out so that they get their money back quickly. So it is generally, I won't say it is an order for which lasts 24 months, but it's certainly between 6 months to 12 months the order would last.
So it basically means that in terms of you would have certain visibility for the current year as well.
We have definitely we have the visibility for this whole year.
And that looks reasonably robust as you see the order book as on now in terms of that looks reasonably strong.
Yes, it looks pretty robust, touchwood, and then as we get into October, then our visibility will go into 25 minutes till that time.
Oh, I see. So, would it be, I'm not too sure, but is it possible for you to share some number in terms of the, say, order intake or something like that? Because, macro tailwind, of course, is there for next 10 years for India, correct? Amritkal is going on. But, that growth of 10, 20, 30, 40, there's a big difference between the two numbers, correct? And to that extent, of course, the profit variance is also very, very high. So, would it be, you might use in a different terminology, high teen, low teen, high 20s, low 20s, but some indicator definitely will be useful for us.
Yeah, so I can tell you that it is robust. We have an order book which is very strong. Beyond that, obviously, I don't want to share. But as we speak, next 6-8 months are pretty robust.
Super. So my second question is with reference to the automobile segment. Typically, the commercial vehicle, segment is a very bulky segment for you, and CV industry is right now going through the what I would say consolidation, or maybe a little bit, kind of downward kind of a trend. But despite that, our margins have improved because normally this is considered to be a little bit higher margin segment. So how we should read that? And despite CV kind of a little bit slowing kind of a growth, you have still reported reasonably good number in a mobile segment. So how we should read this?
So obviously we have reported margins as a whole, not in mobile. We have obviously given the whole quarter consolidated margin. That is how it is. Now, if you want to say that the CVs were flattish and the rest was whatever percentage, as I said earlier I think Ankush was asking the question that margin performance in the quarter is obviously product and mix and leveraging the capacity always plays a role, and then our consistent work in the area of supply chain, steel optimization, extra that plays a role. So our endeavor obviously always is to have a better margin, but sometimes the mix is to your disadvantage and sometimes it is to your advantage. So depending on the forecast and the buyers and things like that. So this quarter, the margin performance is, if I have to kind of say that 3 major points is volume product mix, cost leverage, which was there, and then Timken India Limited, we are relentlessly working with our customers on price realization, and we being kind of market leaders in asking for better pricing in the fraternity.
And inherently, the railways margins would be, compared to say company average margins. If you basically put this, which will be the highest, and in that order, say between railway and mobile and process and exports, how do you basically rank this?
No, I would not like to rank.
Okay, but at least railways will be, higher than the company average. Would that be a safe assumption?
No, I cannot give you my core competence in strategic pointers, but generally, I would say that the aftermarket is always around the globe. Any segment, aftermarket is always the most profitable.
Sure. And last question on my side, in terms of the competition, how do you see the the competitive landscape, particularly on both railways as well as on the process side, because the competitors are also entering into a few segments where Timken has a traditionally very strong hold. So would you like to comment on that?
Yeah, competitors always were there. The competitors and competition has been there and will remain there. And obviously, there are in this segment still today, there are only few companies which have the technology. There might be companies who have money to, say, buy a foreign, nice, great grinding line. But then there is a lot of application engineering, customer engineering, product technology, manufacturing, which only a few companies have. And I'm not saying that the competition will not have everybody in this market over the years, but and this is a game where the mobile we had in 1998, the mobile handset we have today, you can understand what is the technology change happening. The car which I drove first time when I joined Tata Timken back in 1990, the premium Padmini, I used to carry all the spark plug, pana, petrol bottle, everything. Now I need to go TTV there. So so all that put together, I would say that the parent is relentlessly innovating, and obviously other few companies are relentlessly innovating, and this market needs innovation. And then new segments, sunrise segments are coming. For example, I'll give an example that the solar used to be fixed panel. Even in India, till last year, it was generally fixed panel. And then all of a sudden, people understood that, hey, you have to leverage solar to the maximum, and the sun direction to the panel is changing. Now rotating panels, which means small gearboxes, bearings, extracts. So that is one new segment, and not everybody will have the technology to cater to that. Food and beverage. Food and beverage, another segment. Very few people will have the technology to have that kind of bearings or solutions for these new industries which are coming up. And then obviously wind, very few companies will have the reliability to cater to, today it is in India 3 to 5 mega, but globally even 15 megawatt windmills are installed. So you need highly reliable, highly technologically advanced bearings. So we will relentlessly work on innovation. We are working on innovation, optimizing supply chains and things like that. So competition is welcome, and we will compete, and everybody will compete, and winning is important.
And what is your capex for FY25 and 26?
Sorry to interrupt, sir.
This is my last question.
Okay.
What is your capex for FY25 and FY26?
Okay, I think I'm just sure that I am not wrong. I'm just asking Avishant, our CFO, to check that. Sorry? More than 400 crores.
Combined. You mean both combined?
Both combined means?
Or is it each year, or is it 25 and 26 combined?
I'm 24, 25, 400 plus crores. That includes 24, 25.
Yeah, you mean...
these two March 31st of purchase.
You mean 31st March 25, you will spend 400 crores, correct?
Yeah.
Okay, and for 26?
26, I don't have the figures yet, but so this financial year will be 400 plus spending. 400 crores.
Super, sir. Wish you all the best. Thank you.
Thank you so much.
Thank you. Ladies and gentlemen, in order to ensure that management is able to questions from all the participants in the conference, please limit your question to 2 questions per participant. Should you have a follow-up question, we request you to rejoin the queue. The next question is from the line of Rishabh from Premji. Please go ahead.
Thanks for the opportunity, sir. I would like to understand...
sorry, sir, you're not audible. Can you speak a little louder?
Am I audible now?
Yes.
Yeah.
Hi, sir. So my question is regarding the new capacity for the CRB and SRB. What would be the domestic versus export mix that we are planning?
The CRB and the SRB mix is going to be, there are certain applications in this segment which are both available in, where consumption is in India and where consumption is outside. And these varying largely in the size range is the market largely is India, and also there's a nice market in ASEAN and a little bit in Australia as well. And obviously, it has a market in Europe and other places, but our focus on export would be a little bit less, and it will be more domestic. And we are open to exporting more and more, but our first go-to market strategy on this definitely is domestic market, where we are already supplying tapers, and we are well entrenched with these customers, both whether it is material handling or it is cement or it is power extra. So domestic is the priority, and there are markets in ASEAN and nearby countries which would also be catered. I can't give you the exact percentage. Focus is domestic for sure.
Okay, sir, just a follow-up here. So if we were to sort of consider, let's say, 60-40 or anything more than 50 for India, our market share in SRB and CRB would grow a bit closer to double digit versus low single digit, if I'm not wrong, from recollecting from one of your samples. So if we were to sort of grow such a market share, what sort of competitive challenges that we might see, any margin pressures that might come?
So, currently we are selling SRB, CRB in India, and we are importing them from different parts of the world. So obviously, when you are domestically producing, your structure of the cost would be different than when you are importing. So that is one fundamental. You can't produce everything in one country, but whenever you are importing, obviously the cost challenges are more than compared to domestic production. And definitely our penetration in CRB and SRB is less. You are absolutely right, and it is a lot better in tapers. And the idea is that we grow into a double-digit penetration in this area in India, and that is the intent, and that is the path we are taking. And we have already started, testing certain part numbers, extra. So far so good. Looks pretty okay. And now we have to obviously complete the plant and start PPAPing and start selling. But the general direction is that we want to take the penetration single digit to double digit with this plant in India.
So you're confident that the margins won't be impacted despite such aggressive growth?
If every patient remains same, should have a nice impact, positive.
Okay, thank you, sir.
Thank you. The next question is from the line of Abhishek from DSP. Please go ahead.
Yeah, hi sir. Thanks for the opportunity again. Two questions. First is, the parent has got into a lot of M&A in terms of new products, which is coupling chains, belts, pulleys. Any thoughts of actually, starting the distribution of the same in the domestic market? Any thoughts, progress there?
So the whole concept, if you see, is that we want to be on the powertrain, which is right from motor up to the end, and it has coupling shafts, chains, pulleys, lubrication system, and the Timken globally has assured companies which would serve this dynamic powertrain and pretty much high-tech technological companies like Roll-On is, for example, one such company, and Grunwald Becker in lubrication, and Lovejoy in couplings, and Diamond in chains. And definitely India is a growing market, and India is a great place to manufacture, great place to source, great place to export, extra. So currently this is an area where there is a chance for us to grow definitely. And it is not only importing and selling in India. It is like, can we as a company create a supply chain model out of this place and serve the Indian market, serve the globe, saying it's easy, doing is tough. And we are looking at it. We are working on it. Say, for example, on one of the metros, we installed a lubrication system first time and running very successfully already. So we are looking at opportunities and seeing what is the best way to serve this market. And definitely, this is a market which we should cater in India. This is a combined nice market. The parent has the technology, and that technology is available to us. Now, how to optimize the supply chain to cater to the domestic market, and at the same time, see if we can also be part of the parent's global supply chain model.
So, but any thoughts on the timeline?
I cannot comment on the timeline as this creating supply chain is tricky in the sense that you have to either go and buy a company or build a company or have such capable companies in India which can be your source partner. So we are working on it. We have a small team working on it currently, but no timeline which I could provide. Though my intent is the timeline should be faster and faster, but currently do not have any such timelines in front of me.
Got it. So the other question is on exports, which has seen, at one point in time, exports used to contribute to more than 30-35% of your overall top line. In the current quarter, it has gone down to as much as 14%. And if you look at your overall EBITDA margin, still continues to be very robust. So, sir, in next couple of years, given the overall thing which is happening around the globe in terms of wind and other things and China Plus One strategy, you believe on a sustainable basis, given the way your domestic market is also growing, export should be more like a 25 to 30% of your overall top line contribution? Is that the way one should look at it? Any thoughts, sir?
Yeah, I will give you a short answer, yes, 25 to 30. That is the correct answer. The long answer, definitely Indian market is growing. And then, there is definitely China Plus One, which is going to and is benefiting India. A lot of manufacturing shift to India. And then, at some point of time, China Plus One competing against Indian cost, quality, delivery also will be challenge for other countries. So 25 to 30 is a safe range and a safe bet out of our total pie to be exporting. And we want to keep on serving our strategic domestic customers. So, we don't want to kind of drop any domestic customer for exports. Obviously, we want to serve all. And, as the market moves, so shall our capacities.
Got that. Thank you so much, sir, and wish you all the best. Thanks.
Thank you very much. And I think we are very close. I just want to also share, before I take the last question, that you already might be knowing that our CEO, Rich Kyle, which he has shepherded the company very well. He's one of the longest tenured CEOs in his peer group for the parent. Worked professionally for almost 35 years and 18 years with the Timken company. But he led Timken, the parent, through a remarkable strategic journey and has transferred the company into a very nice, high-performing, diverse industry leader. And he has made up, I was about to say, unfortunately, Rich made a very personal decision several months ago to retire. And the company has already selected a successor. The board has selected the successor, and the onboarding process is on. And I'm happy to share Mr. Tarak Mehta is going to be parent's next CEO, and he comes from a very highly acclaimed company, ABB, and from September would be taking over, and Mr. Kyle would work as an advisor to him for some months. And that would be one more change. And Mr. Mehta has been working in the industrial motion, which just now the question was asked about his expertise and more than $10 billion worth of business he has been driving at ABB in the industrial motion segment, which is same kind of, beyond bearings, the powertrain piece of it. So that is another information. And with that, I can go to the last question.
Thank you. The last question is from the line of Bharat Seth from Quiz Investment. Please go ahead.
Hi, sir. Congratulations on bouncing back, strongly. Sir, my only question is that within railway, the way it has grown, so can you give some color which segment is growing faster than, I mean, we are supplying to everywhere, and within that also a margin profile, which is, I mean, give you better for margin.
So currently, if you see the last quarter, rail is the best performing sector, and if I can say, the not so good or same is the heavy truck market. Heavy truck market has been flattish, sluggish, has not reached the peak of 2018, but rail has been our star for the quarter. And I said previously also that rail will keep on doing well over the years, though it might not be a hockey stick, but it will keep on doing well. Now we are waiting for a government change, and which might change policies or steady policies. Definitely, heavy truck scrap policy might be a move which the industry might need as the new government steps in. And if that happens, all of a sudden heavy truck in India would be a hockey stick. But currently, as I see, the two areas which are performing well and will perform pretty well this year is rail, distribution and process, these three industries. And if the new government comes later in the year and decides to scrap the 15-year plus vehicles, then the demand for the heavy truck will certainly go very up. On the margin, I've been telling that continuously that we will not obviously segment-wise give you any indication on the margin. But as a company, our strong margin has been this quarter because of the product mix and as a nice leverage on the cost, and obviously price realization has been strong despite challenges of the softening of the metal pricing.
So is it a fair assumption that railway is the highest so better product means is rail generate little better than margin than the company level? And within rail, if you can give some color which is growing faster and which you expect to faster, like Vande Bharat, Wagon, and other freight.
So in rail, actually, obviously we have to see the base. Freight has the largest base, so freight is growing. Metro has a very small base. It is growing, but obviously when you see the base is very small, even if it grows by 100%, the base is pretty small. Wagon base is big. There even a 5-10% growth is pretty significant in terms of dollar or INR. And certainly electrification is pushing the locomotives, and Vande Bharat in the passenger after wagon, that has the second largest base. Vande Bharat is following. So wagon consumption, I'm saying if you see the whole pot, wagon has number one for the build side. I'm not saying margin side, for the build side, followed by passenger and then metro and locomotive. So that is how it's going to play out. And on margins, I am not advised to tell you the margins in segment-wise, but our endeavor is to obviously steal the race and work hard to make sure that we optimize costs wherever it's possible.
So do we believe there's a Q4 margin is sustainable for the full year FY25 or maybe some softness?
As I said, that it is volume and mix driven. So some quarters go up, some quarters come down. So that up and down remains for every company. If your product mix that quarter was bad, so it can come down. But what is sustainable is how your supply chains are behaving, and if you have good demand, then how do you leverage that volume, which is very, very important in our industry. So the endeavor is obviously profitable growth, and quarter to quarter mix will play its role.
Okay, thank you very much, sir, and all the best.
Thank you so much. Thank you very much. With that, thanks a lot for the questions. I always learn more from the questions. I hope you got the answers, and thanks a lot for Spark for coordinating. Thank you and Jai Hind.
Thank you. On behalf of Avendus Spark, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.